What if I told you that in just a few minutes you could unlock the secrets to growing your wealth? Imagine being able to invest your money smartly. No more wondering if you're doing it right. Today, we're diving into the top 5 investment strategies that every beginner should know. These aren't just theories, they're proven ways to set yourself on the path to financial freedom, starting right now. We'll cover everything from simple hands-off approaches to more hands-on tactics so you can find the perfect strategy that aligns with your goals and risk tolerance. So, buckle up, hit that subscribe button, and let's unlock your wealth-building potential together. Let's begin with index funds, a powerful tool for any investor. Think of these as the easy button of investing, simplifying the process significantly. Index funds are low-cost investments that allow you to own a small piece of the entire stock market, making it accessible to everyone. Instead of trying to pick individual stocks, you're essentially buying into the entire stock market with a single investment, which is much easier and less stressful. It's like having a diversified portfolio from day one, spreading your risk across many assets. You're not putting all your eggs in one basket, which reduces your risk and increases your chances of steady returns. And the best part? Index funds typically have very low fees, meaning more of your money is working for you rather than being eaten up by costs. I remember when I first started investing, I was overwhelmed by all the options and didn't know where to begin. But then I discovered index funds, and it was like a breath of fresh air, simplifying everything for me. They were simple, straightforward, and I could start investing with a relatively small amount of money, making it accessible for beginners. Over the long term, index funds have been a cornerstone of my investment strategy, providing consistent growth. My advice? Start with a broad market index fund, like one that tracks the S&P 500, to get a solid foundation. This will give you exposure to a wide range of companies across various sectors, providing instant diversification and stability. Now you might be thinking, I'm just getting started, how do I handle the ups and downs of the market? Trust me, I've been there. It's a common concern for new investors. Watching your investments fluctuate can be nerve-wracking, especially when you're just starting out. The constant ups and downs can make you feel uncertain. But here's the thing. Trying to time the market, buying low and selling high, is incredibly difficult, even for seasoned investors. It's almost impossible to predict market movements accurately. This is where dollar-cost averaging, or DCA, comes in. It's a strategy designed to mitigate the risks associated with market volatility. This strategy is all about consistency and discipline. By sticking to a regular investment schedule, you can avoid the emotional roller coaster of market timing. Instead of investing a lump sum all at once, you invest a fixed amount of money at regular intervals. Every week, month, whatever works for you. This approach helps you stay committed to your investment plan. Think of it like this. When the market is down, your fixed investment buys you more shares at a discounted price. It's like getting more bang for your buck. And when the market is up, you're buying fewer shares, but at a higher price. This balances out your average cost per share over time. This strategy helps to smooth out the volatility of the market over time. It reduces the impact of short-term market fluctuations on your overall investment. Let me give you an example from my own life. Personal experiences can often illustrate concepts more clearly. When I first started investing in real estate, I was so eager to jump in and buy a property that I almost drained my entire savings. It was a risky move, but then I remembered the power of DCA. It was a game changer for me. Instead of putting all my eggs in one basket, I decided to invest a portion of my savings each month into a REIT. This diversified my investments and reduced my risk. This allowed me to gradually build my real estate portfolio without putting all my capital at risk. It was a more sustainable approach. Even if you can only invest $50 or $100 a month, that's perfectly fine. Every little bit adds up over time and helps you build a solid financial foundation. Strategy number 3, real estate investment trusts, or REITs. What if I told you that you could invest in real estate without actually buying a property? No more dealing with tenants, toilets, or late-night maintenance calls. Sounds pretty good, right? Enter REITs, or real estate investment trusts. These are companies that own, operate, or finance real estate projects, and by investing in them, you get a slice of the real estate market without the headaches of property management. REITs are required to pay out a significant portion of their profits to shareholders in the form of dividends. This makes them a great option for investors looking for passive income. Early on in my career, I was laser-focused on building my real estate portfolio. I loved the idea of owning tangible assets, but managing properties was time-consuming. That's when I discovered REITs. They allowed me to diversify my real estate holdings without the added stress of being a landlord. If you're looking for a way to add real estate exposure to your portfolio without the hassle of direct ownership, REITs can be a fantastic option. Strategy number 4, diversification and asset allocation. This strategy is fundamental for any investor looking to build a resilient portfolio. You've probably heard the phrase, "Don't put all your eggs in one basket." This age-old wisdom is particularly relevant when it comes to investing. In the world of investing, this couldn't be more true. Diversification helps to spread risk and can lead to more stable returns over time. By spreading your investments across different asset classes, stocks, bonds, commodities, and even cash, you reduce your overall risk. This way, you are not overly exposed to the performance of a single asset. Think of it like this. If one investment takes a hit, the others can help to cushion the blow. This balance is crucial for long-term financial health. How you diversify your portfolio will depend on your risk tolerance, time horizon, and financial goals. Each investor's strategy will be unique. For example, a younger investor with a longer time horizon might be more comfortable with a higher allocation to stocks, given their potential for higher returns. On the other hand, an older investor approaching retirement might prefer a more conservative approach with a higher allocation to bonds, which are generally less volatile. Early on in my investing journey, I made the mistake of putting a significant chunk of my savings into a single tech stock. It was a risky move that didn't pay off. The company's performance fell short of expectations, and the stock price plummeted. This experience was a harsh lesson in the importance of diversification. I learned my lesson the hard way. Diversification is key. It's a strategy that can protect you from significant losses and provide more consistent returns. These days, my portfolio is spread across a mix of stocks, bonds, real estate, and even alternative investments like cryptocurrencies. This diversified approach has helped me achieve a more balanced and secure financial future. Strategy number 5, robo-advisors. If you're not sure where to start or don't have time to manage your investments yourself, there's a tool that's revolutionizing the game: robo-advisors. These are automated investment platforms that create and manage a portfolio for you based on your financial goals and risk preferences. You simply answer a few questions about your investment goals, risk tolerance, and time horizon, and the robo-advisor takes care of the rest. They'll build you a diversified portfolio, automatically rebalance it as needed, and even reinvest your dividends for you. It's like having a personal financial advisor in your pocket, but without the hefty fees. I remember when robo-advisors first started gaining popularity, I was skeptical. Could an algorithm really outperform a human financial advisor? But after doing some research and trying out a few different platforms, I was impressed. The technology behind robo-advisors has come a long way, and they've proven to be a valuable tool for both beginner and experienced investors alike. They're a great way to get started with investing without having to become a financial expert overnight. So there you have it. 5 powerful strategies to help you start your investment journey. But remember, the key to success isn't about choosing the perfect strategy, it's about taking action today. The earlier you start, the greater your potential for growth. If you found this video helpful, hit that like button, and don't forget to subscribe for more strategies to grow your wealth. Remember, your future wealth is just a few wise decisions away. See you.